All right, guys, welcome back for another video. Well, in today's video, I want to talk about the federal funds rate and the different yields on different treasury maturities and what's going on in the dollar currency index. But, first I'll start with, the recent development in the dollar currency index, taking out last week's high right here. Now, remember, you may have seen my previous video talking about the parabola in the dollar currency index, the blow off. The dollar currency index blew off its parabola. Expanded volatility to the downside, and then entered a period of relative volatility contraction relative to the prior expansion right around here. You can see this by sort of narrowing range right into here, and then you get your expansion of volatility. Now, if we go to the RSI, we can see that you've got bullish divergence on the RSI. That's something that generally forms at the bottoms. And it's not crazy, but you do have lower lows and then higher lows on the RSI right here. So it's generally characteristic of what you see when price enters more of an accumulation mode. You generally see this RSI divergence be put on low volatility, and then you get the expansion. Remember, you don't confirm the RSI divergence until you take out the highs. So this divergence right here is not confirmed until you take out these highs. And at this point, this is looking like a breakout on the DXY. So, there are certain methodologies you could implement to keep an eye out for a swing failure pattern. But I think, just from a probabilistic perspective right now, I would treat this as a breakout in the dollar currency index, and, ultimately be looking for some continuation higher, particularly to this area over here over the long term, of course. Now, I do want to dive into Treasury yields and the federal funds rate. Now, if you guys have followed the FOMC meetings at all, you know that the Fed likes to talk about the federal funds rate, which is the interest rate that they set. Now, they don't set every interest rate in the world because they're not a lender in most transactions, but what they do set is the federal funds rate, which is the effective federal funds rate that they yield on their lending activities, which essentially sets the yield floor in the market. Now, where that's significant is in the reverse repo market. So the reverse repo market is a facility at the Federal Reserve where member banks can park capital at the Fed for zero risk and achieve a yield that is set by the federal funds rate, and that's an overnight yield that's based on, well, it's an annualized yield paid at an overnight rate, so they don't have to lock up capital for a year to achieve that annualized yield. They just, they can lock it up for as many days as they want and get a prorated basis of that annualized yield, which is 4.33 currently, if we look at the federal funds website right here. Now, why am I mentioning this? Okay, well, it's significant because if you look at this graph here, what I want to point out as significant is whenever you see the federal funds rate rise above Treasury maturity yields, that's very, very significant. And I just want to focus everybody's attention on that because, generally whenever the federal funds rate rises above the yields offered by U.S. Treasury securities, that's the top of your interest rate hiking cycle right there. Historically, you can see that, in 2006, 2017, 2018, 2019. So this area right here, this area right here. You can see, and there's a structural reason for that because with bonds, you have inherent risk, right? You have credit risk, and you have the risk that the value of the bond itself declines significantly. And, that risk isn't there in the reverse repo market. So essentially when the federal funds rate yields a higher yield than the bond market, why would investors buy bonds when they can get a higher yield with less risk in the reverse repo market? That is the existential question facing most banks right now. And of course, they wouldn't do that, right? They would tend to park capital at the higher yield for less risk, which is why you see the reverse repo market spiking. We actually saw that spike going into the end of the year. So just before the end of the year, you see this thrust up. But really, ever since interest rates really started hiking, you've seen this reverse repo market kind of explode. Right now, these are billions of dollars. So this, it rose to basically 2.5, 2.6 trillion just by end of year, this last final spike right here. So 2.5, 2.6 trillion. I mean, that is a huge, huge market. That's a lot of liquidity that's being parked at the Fed, and that's US dollar liquidity that's not in the open market, right? If it's parked at the Fed earning a yield, that's basically represents US dollar liquidity that could be injected into the economy that's being held at the Fed. Um, but, what we saw briefly was we saw the 2 year yield drop just below that. So remember in December, the federal funds rate was at 4.33. So we actually saw the yields. This is the 2 year Treasury yield, 2 year government bond. We actually saw the yields drop below that 4.33. Let's see if we put this on there. Yeah, 4.33. So it found support at that level, bounced off, and then broke below it. Now, it just recently broke back above it. Remember, this 4.33 is from the effective federal funds rate right there. So it's actually above it now. Now, every you have an inverted yield curve, so um, the 2 years yielding more than the longer duration treasuries, which is, a whole rabbit hole in itself. I won't go down that. So these other, longer duration treasury bonds are all yielding significantly lower than the federal funds rate, which is a huge issue. Um, you see the 2 year dip just below that region and then rise above it. But this is something to keep an eye out for because you can mark this line off on your chart on the 2 year because you know whenever you have the yields on any treasury, or especially when you see the yields across all duration treasuries drop below that federal funds rate, that represents severe disruption in the bond market. Again, going back to the existential question, why would investors park capital in a market with higher risk and less yield, right? They wouldn't. So, that represents a large demand destruction in the bond market. And if people aren't stepping in at treasury auctions to buy the bonds that the U.S. government needs to keep itself financed and to fund its operations, then the Fed will have to act. Right, the Fed is the buyer of last resort in that market. They have to cover the difference between the organic demand that exists in the bond market and what the U.S. government needs to fund its operations. So anyway, just let's go through some of these slides right here. This is interesting. This is U.S. to money supply. Actually, this year is the first year that the U.S. money supply has actually decreased from an M2 money supply perspective. So that puts things in perspective. Probably, this will probably lead to CPI prints, through 2023 that generally surprise to the downside, right? People are kind of underestimating how quickly prices are collapsing on goods and services. So I think we're in for a little bit of a deflationary surprise in 2023. We talked about the reverse repo agreements. Now, this is just a measure of the U.S. Total public debt. I think where it's important now is remember um, yields have risen dramatically. So any of this debt that's being, it's not being paid off. It's just being rolled over when this debt hits maturity. It rolls over and gets issued at new maturities with new duration, right? It's just being refinanced. But the significant point here is that it's being refinanced at higher interest rates, which actually guarantees that we have more inflation in the future because it increased the cost of government financing, and government spending is synonymous with government debt. If government financing goes up because of higher financing costs, then that increases the amount of spending that we're guaranteed to see in the future, which further leads to higher inflation. So that's an important thing to keep in mind. And finally, I just want to talk about this. This is the liabilities and capital earning remittances due to the U.S. Treasury. So basically what this is showing you is that this ties back into the relationship between the federal funds rate and the Treasury yield. So generally, when the federal funds rate yields less than the Treasury yields, that's a healthy market, and it represents actual pricing of risk and reward, where the federal funds rate should yield less in the bond market because it has less risk, right? And that's generally what you see. And in that situation, the Fed is able to remit its earnings to the Treasury because it has to pay out less on its federal funds rate to the member banks that are parked there than the yield it's getting from the bonds that it holds on its balance sheet. So but again, this has recently flipped to the to the opposite side now, where the Fed has all these bonds on their balance sheet. And remember, a lot of those bonds on the balance sheet were, have maturities that they were purchased during the pandemic when yields were extremely low. And now they have to pay 4.33 on the reverse repo market. Remember, that's a market where they're borrowing and paying interest from member banks. And the differential between the yields that are on their balance sheet and the interest payments they have to pay the member banks is causing these liabilities and these holes in their balance sheet, and drastically reducing the earning remittances that the U.S. Treasury receives from the Fed. So the Treasury is used to receiving these kickbacks, and now they're, quite literally not at all. So that's something that will be a political issue. It doesn't take many politicians are going to say, well, okay, why are the earning remittances going to these big banks, right? And not, why is essentially taxpayer money going to these large banks and not the people? And I think that, combined with the fact that you're seeing a collapse in the money, not just CPI, but the money supply and the CPI as well, even though it's a lagging indicator. I think those two in combination with each other, you probably see a 2023 that's very different than 2022, where people start to get afraid of the deflationary issues and start questioning some of the policies that the Fed has enacted, and really holding them to the fire for some of the credit contraction that we're already starting to see in the market with banks. Even though they're flush with liquidity, they're just really, really, really tightening their lending standards and not, injecting any of that liquidity into the economy to stimulate economic activity. Just a long way of saying that, the Fed may be blamed for pending mounting job losses and potential looming recession in 2023. And that may be the topic of discussion, more so than, what we saw in 2022, where, inflation generally dominated the discussion. Anyway, I hope you guys like this video. If you guys haven't subscribed to the channel, please make sure to do that. And I'll catch